Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
I have been looking for any excuse to wear a hoodie on camera, and I'm surprised you're not wearing a hoodie. And it's like the uniform for crypto people.
Well, it is. I have about 5 different hoodies that I recycle every week, and they're all unfortunately in the wash today. So,
All right.
Yeah.
Well, good to know that they get washed occasionally. Welcome to another episode of Trends with Benefits. My guest today is Pranav Kanade. Did I pronounce that right?
Kanade, but it's all
Kanade.
good.
Pranav Kanade. Cool. Welcome, Pranav.
Thank you. Thanks, Ed.
Pranav, you're a portfolio manager at Van Eck for a digital asset strategy, right?
Yes, correct.
Got it. And I don't know, maybe just give me a quick little snippet about what that's really about.
Sure. So we are a long bias hedge fund strategy. We're bullish tokens as an asset class, and we're bullish Web3 as a theme. And the goal of our strategy is to underwrite and own 20 to 30 projects that we think will be the best performers in the liquid token space. I have a very nice team of investment team members that help me select those projects and help me value them, think about how big they can get in the future. And we also have a fantastic trading team that helps me manage risk around these projects. So if things get overvalued, we will sell some exposure. Things get cheap, we'll redeploy and buy back that exposure. Needless
to say, you've got a pretty good view, I think, of the ecosystem in the crypto economy. And so I guess that's the reason really that, I wanted to talk to you on the podcast, to get your perspective of things. Obviously, when we started talking about this, things were quite a bit different. Crypto was going through a downturn, or still going through a downturn. But then as we record this now in mid-November, we've had the FTX debacle just in the last week or so. And, before we get into the rest of it, and I don't necessarily want to go into all the details here of what they did or didn't do and things of that sort, but really just kind of get your perspective as a way to maybe reframe people's perception of the crypto market. It was, I feel, beginning to get some traction and adoption. I don't know. What's your take on FTX and its impact to this market?
The obvious surface level impact is massively negative, right? This is the equivalent of an Enron happening to our space. It's ironic that the CEO of FTX through his bankruptcy process is the person who did the Enron bankruptcies. That tells you everything you need to know. Now, when I take a big step back, like why we are all in this industry and what the technology and the promise is all about. Bitcoin was the first one from a cryptocurrency perspective. Bitcoin is trying to disrupt money by allowing for the creation of a peer-to-peer money. Everything else in the Web3 space is trying to allow peer-to-peer commerce to happen, allow peer-to-peer computing to happen, such that applications can be built on top of them. So if you can think of Bitcoin trying to disrupt money, everything else is trying to disrupt any industry that has a traditional middleman, which ultimately will allow for peer-to-peer commerce. So the irony of all of this is the middleman in this case was the one that failed. So the technology wants to have a system where there is no middleman. And so ironically, it really proves the purpose of this technology, which is if the end users were using decentralized exchanges built on Ethereum, they would be self-custodying their assets, and this would not have happened in the first place. All of this really happened because users decided to put their assets on an exchange, and the exchange turned out to be fraudulent.
I guess there are decentralized exchanges currently.
Correct.
Are there of any size?
Yeah. So we were just looking at the volume data recently. As this has unfolded, there's been a big volume shift to decentralized exchanges because most market makers, as well as people with assets, crypto assets, don't feel comfortable leaving money on exchanges. So they're choosing to transact on decentralized exchanges. Ethereum has a dominant market share among decentralized exchanges, and among the decentralized exchanges, the bigger ones are Uniswap that we are investors in, but also there's other smaller ones that I don't need to get into. There are also aggregators that essentially, again, are decentralized, but they will ultimately execute your trade in the most optimal place. So there are ones that are getting meaningful market share.
Yeah. I was at a conference recently and somebody said that the Bahamas is a very well-regulated place and that this whole FTX thing was not necessarily a failure of regulation, but it was just criminal.
Yes.
What's your take on that?
From again, from everything that we know that is available through Twitter and news sources and everything, this seems criminal. It's the simplest answer, right? Like when you go use an exchange, like a Coinbase or in this case FTX, um, you are depositing some assets. Like let's say you're depositing Bitcoin or Ethereum or whatever else to transact. Um, the exchange is not supposed to take those assets and sort of speculate with them, right? In this case, customer deposits were being used for all kinds of speculative behavior and nefarious activity. So this is, in my opinion, it looks fraudulent.
Yeah, yeah. And from the outset, there seemed to be, I guess, more of an echo chamber of like more regulation will come, or hopefully here in the U.S. regulators will do something. Do you think this will spur more regulation and eventually be a positive for the industry?
100%, I think this will spur more regulation. It's been clear that the regulators want to ultimately focus on regulating stablecoins, but also they want to regulate the centralized exchanges, the trading venues for these places, and ultimately also want to regulate this big debate on what's a security and what's a commodity, right? Those are kind of like the three big areas. So we think this will accelerate regulation on probably all three fronts. It's always been our opinion that the space does need regulation. So if you look at any technology historically, whether it's cars or the internet or anything, having some rules around what's acceptable and not acceptable will make everyone else in the world feel comfortable to come in to the ecosystem and experiment and learn and potentially do productive things. So we kind of view that as a potential positive.
Yeah, I guess right now there's really no guide rails, right? And different states do different things. And
Yeah, there's some guidelines. I mean, there's obviously, I think there's a meaningful amount of guidelines if you're operating in the United States, with a lot of things in the gray. And because of the things in the gray, companies have chosen to go offshore, hence like this Bahamas entity, right? So if the amount of gray is cleaned up to be black or white, I think that will potentially bring a lot of activity back to the United States and will allow people to transact and do things in a safe place.
so then what's your take? So we've experienced 2022 as a downturn in the crypto markets. Does FTX change that or recharacterize that? It was a lot of people refer to it as a crypto winter. Does this become now a crypto ice age?
The short answer is it's hard to tell. So one of the areas we go back to as a team is we say there's about 300 million people in the world who own crypto assets. Most exchanges have about 100 million monthly active users if you aggregate all of them. So that tells you there's about 100 million people in the world that are just speculating on different tokens. And then if you look on chain, there's about 2.5 million daily active users of applications built on the blockchain. What we care about the most as investors in the space is seeing that 2.5 million daily active user number become a much larger number, because that 2.5 million are the actual people finding some utility or use case or value from these tools and these products being built on a blockchain. So we're hyper focused on that 2.5 million number. We want to see that go to 100 million over the next couple of years. And so the projects we're investing in are the ones that are solving problems that for 100 million daily active users, hopefully. So whether we are in a winter or an ice age is a function of how quickly those use cases come together to solve problems for people.
And how much of that do you think is going to wait until there is more clear regulation, or will it continue to see adopters?
No, look, some of it does require clear regulation. So, as an investment team, we've outlined three primary categories that are near-term catalysts for the space from a growth perspective. So those are payments, Web2 companies creating Web3 experiences to improve customer retention or lower customer acquisition. And the last one is this area called proof of physical work. So we're happy to unpack each one of those three categories, but let's just take payments, for example, right? So today, if you go to walmart.com and swipe your credit card and spend $100, Walmart typically will see $97.50. So the $2.50 is getting split up between a payment facilitator like a Stripe and then a merchant acquirer, the bank that's servicing all these things, and then the Visa and MasterCard networks, right? Now, a similar e-commerce transaction, if done on blockchain rails and still again using Stripe, because Stripe is the facilitator at all these things. Stripe recently started experimenting with stablecoins as well, would potentially save Walmart as much as $2 of that $100 transaction. So instead of realizing 97.5, they could realize as much as 99.5. So it's a big margin uplift for a traditional Web2 player. So payments is a huge category. Now, there has to be clarity on stablecoins, for example, for a lot of people to then come and adopt this, right? Having clear regulatory regimes will help with that. In that second category of Web2 companies trying to do Web3 things, in this past few months, we've seen Facebook/Meta announce that they are essentially allowing for minting and also displaying of NFTs on Instagram. That's a big deal. I imagine they're doing so because they think that will increase engagement on Instagram. We heard Starbucks say that they're going to look to potentially transform their loyalty program that we all use in the Starbucks app, like the little diamonds we get, right? Transform that into an NFT type experience. Again, Starbucks is looking at this and saying, doing something in Web3 will potentially enhance my consumer's experience, right? We saw Nike announce something interesting yesterday. They're creating a marketplace themselves for NFTs. I imagine they want to create some kind of NFT token gated shopping experience when you buy your sneakers. So we're seeing a lot of these Web2 companies build Web3 experiences, and which blockchains they build on and which infrastructure tools they use will be the key beneficiaries of all of it, right? And we are investing in those underlying tools, like the picks and shovels, you can call it. Now, that area doesn't really require a lot more regulation, I don't think. Hence, these guys are really moving in. But the first area of payments does require some clarity and regulations.
Just briefly, before we go any further, maybe you can explain Web 2 versus Web 3, kind of what you're really talking about there.
I would say Web 2 is probably the current state of the internet. And the simplest way I think about it is these are just data silos and companies kind of doing things on their own. So for example, when you have your Instagram experience, it's very different from your TikTok experience because your identity on each one of these platforms is very different. So your identity you've created on Instagram has been a collection of all your activity over the last 20 something years, right? That's kind of like Web 2. Web 2 are these data silos and compute silos that is all sort of in the control of Web 2 monopolies or sort of big companies. Web 3 is about using public ledgers and public blockchains. So rather than having each company control its own data center and having all their compute and storage on that one data center, it's using a public computer, if you want to think about it, a gigantic computer, which is the blockchain. And there are many of them. There's Ethereum, there's Solana, there's Avalanche, there's a bunch of these things. And then building applications on those public blockchains. And what that allows or facilitates is interoperability. If you kind of use the same social media example I was giving you, if social media was rebuilt on Web3, what that would mean is you, Ed, would actually hold all your user data and you would permission anyone, any application to use that user data to create your user experience. So what you could see is a pretty fluid user experience with different front-end user interfaces and sort of a more curated experience for yourself.
Kind of what I heard from you was the growth will come not so much from adopters of investors in cryptocurrencies, trading cryptocurrencies just for the pure sake of profit, but application users, companies looking for ways of improving their processes.
Yep.
Is that fair?
That's 100%, right? All these things need to solve a problem and a use case, and the problem doesn't have to be like something that's like a big friction in our society, right? It could be, right? So DeFi is trying to reduce the friction people face in the traditional banking system, so that is doing that. The things within NFTs and sort of e-commerce or NFT enabled e-commerce is more about creating a fun experience for the user, a better experience than what already exists. So it could just be something that's different and better. So again, going back to the underlying premise, it has to solve a need for the user. So a lot of it could be like it's saving someone money and time, which is kind of what a lot of DeFi is about. While something on the NFT side could be a lot more about the average American spends something like 3.5 hours a day watching TV trying to entertain themselves. And can we create something that takes away from that 3.5 hours a day that's equally entertaining and actually potentially more engaging and fun?
Tell me a little bit about kind of what you do on a day-to-day basis in terms of looking at various projects in this case being, I guess, looking at different crypto blockchains, to throw a bunch of words
tokens.
Together. Yeah, token. Okay.
Yeah.
So that's another word. Okay, tokens.
Yeah. Crypto and tokens are the same thing, right?
Yeah.
So the way I think about it is, I'll define a token if that's easier. So tokens are a different form of a capital formation tool. So similar to stocks or bonds, they give you some form of, it gives you property rights in whatever shape or form, right? So in most networks, which are what blockchains are all about, there is no shareholders equity. There is no equity. The value accrual tool is the token itself. So when someone uses an application built on the Ethereum blockchain, let's just use the Nike example I was talking about, right? So Nike is building a marketplace, it seems, right, where people can buy Nike NFTs and potentially shop with Nike NFTs, whatever they want to do. Let's just say it was built on Ethereum. I think it probably is, but let's just say it is. In that example, when someone buys or sells their Nike NFT, which could allow them to potentially even buy physical goods or anything, they pay fees to the Ethereum network. Those fees ultimately flow to ETH, the token, right? So there's no Ethereum stock. The token is the asset that gets paid when someone uses this thing. So tokens to me are just this hybrid instrument. That's on the one hand, it's a capital formation tool, like where that accrues value from the growth of these platforms. On the other hand, it could be used to increase adoption. So if you can create intrinsic value for this token through cash flows, then you could also use that same asset as a reward for participating in these networks. So something that cannot this is something that doesn't exist in the traditional world, right? So, imagine 20 years ago when Amazon Prime was getting started, Jeff Bezos could have said, hey, every Prime user that comes, the first 10 million Prime users that joins my network, you get 2 shares of Amazon. The next 10 million, you get 1 share of Amazon, right? If you could have created a network mechanism that could have that could have rewarded user behavior from this value accrual tool, then I think Amazon Prime would have hit like 70% of US households way faster than it previously did. So that's kind of how you think about tokens. Tokens kind of allow for that to happen.
And so, in terms of what you are looking at in the ecosystem, you said you're interested in payments and Web2 to providing Web3 experiences. And what was the third one? NFTs?
The last one was this area called proof of physical work.
Proof of physical work. Oh, maybe you can explain that one a little bit.
Sure. So again, the overall goal of everything in the Web3 economy is to displace middlemen. So the proof of physical work movement is about can we rebuild existing networks by getting humans to coordinate to do that same existing thing, with the token being the asset that pulls it all together in some way, right? So the Helium network was the first one to really do this kind of successfully. And so essentially the Helium network is a mobile/IoT network that says, hey, Ed, put this $500 hotspot in your house, and as a result of you putting this hotspot in your house, it connects to your Wi-Fi and it's going to propagate service in a certain radius. And if a whole bunch of people do this, then you create essentially internet coverage across the country, right? And in this case, it was started for IoT, Internet of Things devices, and now they're migrating to doing this for 5G as well. And so they essentially deconstructed a telco business, and they allowed people to construct the same network and people to benefit from the economics of growth of that network. So the human being is doing something physical, which is in this case putting a piece of hardware in their house. There's another one that's coming to market called Hivemapper. We actually had the CEO on our webinar recently, but essentially they're trying to displace Google Maps. Today, Uber, DoorDash, all the big apps use Google Maps. They pay Google for the Google Maps API. And the way Google builds their Google Maps is they have a whole bunch of these little cars that they purchased and owned that drive around the world and, essentially picture or photo different streets and map the world. Well, in the blockchain world, you can kind of do it with human beings doing, like just regular people doing it. So Hivemapper has built this thing where you put this dash cam in your car and you just drive around as usual. But when you're driving around as usual, you're just mapping whatever streets you're driving around. And in order for doing so, you're getting paid in this thing called honey tokens. Anyone that wants to use the Hivemapper API will pay in dollars, which will then be used to pass on that value to the honey tokens. So it's essentially, let's rebuild Google Maps, but build it where we're crowdsourcing it essentially. And what the end result will be is potentially way cheaper mapping service than what Google can offer, because everyone is contributing to this thing. But also it's more live. So you get to collect map data live versus, most places in the world, Google only tracks, I think, on a 2-year basis. It updates the maps every 2 years.
That's cool. And let's continue with that one for a little bit, if I might. I think one of the biggest conundrums in this space for traditional investors is how do you value these assets? And something like Hivemapper, if you look at that, what are you looking for?
So the way we think about valuing a Hivemapper, for example, is demand based. So ultimately, what are people willing to pay for the Hivemapper API? And that could be measured on a per unit basis, and then we can extrapolate that to the number of users and say, okay, in year 10, this is how many dollars could be paid from outside users of the Hivemapper API, and then that cash flow stream, how much value goes to the token honey versus how much value is leaked somewhere else. In this case, most of the value goes right to the token honey through this burn mechanism. So they reduce the supply of honey. Think of that as like a buyback. So we're essentially trying to value the cash flow that this project could generate from demand at some distant point in the future.
And in terms of types of investment opportunities out there, what are some of the different ways of getting exposure?
My framework for getting, let's just say, exposure to Web3/crypto is you have kind of three options. One is you're going to go buy a basket of tokens yourself. There's 19,000 plus tokens out in the universe. You have to go figure out which ones you want to buy, and you need to have some framework for figuring that out. I think that's a hard option. Do it yourself. You have to dedicate a lot of time and resources to figure out which ones are the best and which. So my personal view is, if you look at the Apple App Store today, there's 2.5 million apps. But if you kind of think about the GDP of the Apple App Store, like the top 100 apps generate most of the value, right? Like the Ubers, Instagrams of the world. So like everything else is kind of worthless. I think you'll see a similar thing happen in the crypto world where like the top 50 tokens will probably generate a lot of GDP or value, and everything else will be wasted. So if you believe that, then picking tokens yourself, kind of do it yourself is hard. You have to spend a lot of time, and you can invest in venture. So most venture investors in the crypto space invest in seed deals and Series A deals. These are very early. We believe venture is an access class, not an asset class, especially in crypto. So, we think the best venture funds see the best founders and the best deals. And then, kind of like your long tail of venture funds, I think see generally poor deals and, will have weaker performance. And generally, if you're participating in a venture fund, you're probably locking up your money for a very long period of time. And then there's, a liquid token fund as an option as well, where you allocate to a manager, passive or active, and they determine how to then allocate that money into the token space. Now, the difference I would draw between tokens and traditional equities is tokens are still venture assets. So in the traditional world, a project will go from seed round to IPO in, let's just say, 6 years. In the crypto world, projects typically go from seed round to liquid tradable token, something like 18 months. So yeah, you're getting kind of venture-like exposure in the liquid asset. Is how I think about it.
That's interesting. And that's an interesting, I guess, correlation between those two. I mean, would you see potential regulation coming that would limit the types of people that could get access to tokens, kind of like with venture capital, you having to be a certain net worth and such?
It's hard to say. I personally don't think a net worth based test makes a lot of sense, because you might have someone who's 22 out of college that has a small amount of net worth, but has studied this asset class and understood economics and understands markets, who might be very capable of picking tokens and picking assets, and they might not have the net worth. So limiting that demographic just because they don't meet some net worth test doesn't make a lot of sense to me. I would be a big advocate of doing something that's more knowledge based. So if there was like a driver's test essentially to see if you're, if you're aware of the risks and aware of how this market operates, and you take some kind of a test, then you can participate. Like I think that makes more logical sense, but it's hard for me to kind of guess on regulatory stuff there.
Yeah, no, totally. I just, as you were talking about venture and the similarities, I was like, okay, well, it's obviously an easy way of getting access to a venture type of activity. So I thought it was just kind of interesting. We'll see how that plays out. And I tend to agree with you too. If there has to be anything, maybe more knowledge based. And I think we saw that more recently with the SEC and just kind of private investments and relaxing those rules a little bit for people, even with people in the financial industry who have certain licenses, being able to invest in private funds and things of the sort.
Yep, makes sense.
One other area of the digital economy, other than just the tokens themselves, are companies that are participating in the space. Do you is that a potential investment for you in the strategy that you run?
Yeah, absolutely. We are looking at companies and equities, as well as convertible notes of companies, especially as things have gone into distress. That's definitely an area it's in the crypto world, it's called Web 2.5, right? In between Web 2 and Web 3.
Man, you're killing me with the terms.
Yeah, I know. But that's an easy one to understand, right?
Yeah,
it's like you're not all the way there. So like if Web 2 is centralization, Web 3 is full decentralization, Web 2.5 is like progressive decentralization. So you can't quickly pivot to that extreme. you kind of are somewhere in this middle. And we are generally bullish Web 2.5 as a category. We think companies that already have scale, have a lot of users, and can come up with a unique or novel way to reduce their customer acquisition costs or increase customer retention by using Web3 tools will be ultimately big winners, because that will give them a leg up over their other competitors who are not doing the same. So we're absolutely looking at that.
What's one long-term trend you see playing out over the next several years?
A bigger value shift towards creators. So what I mean by that is today, if you're a big YouTube creator, you probably, I think, see 45% and YouTube keeps 55%. If you're posting great pictures on Instagram, obviously Instagram keeps 100% unless, and you'll probably make some money if you're getting some sponsorship, right? So if someone's getting you to post sponsored content, that's how you'll make some money. And I think that's completely out of whack. I mean, you can even think about it in the music industry. Like, the publisher of a music catalog sees like 80% of the royalties, while the artist sees 20%, something like that. It's the mix. So we've always lived in this world where the economic mix between creators and the people that own the distribution pipes are lopsided, and we think Web3 Rails allows you to flip that economics upside down, where the creator keeps a disproportionate amount of the economics, and because there is no distributor, right? There is no middleman. So the systems we're seeing develop as we speak are ones where the creator keeps a lot of the economics, and the fans or the consumers of that content keep the remaining economics, because we've gotten rid of the middleman.
That's probably going to take me some time to really understand that. I mean, because the fans of the creators still have to find the creators somehow, right?
Right.
And that might mean some middleman platform, no?
Correct. So take the simple example of just art, right? So there's this project called Art Blocks. It's a traditional NFT art collection. I think it was like featured in Sotheby's and all the big places, right? So, if you were to buy an Art Blocks piece on OpenSea, you're still paying OpenSea a small royalty for being the marketplace where the creator or the owner of this content and the buyer or seller get to meet, right? But that take rate of 5% or whatever OpenSea will take, I think it's 5% on OpenSea, is a fraction of what traditional Web 2 platforms take as a take rate from the creators themselves.
Cool. All right. You ready to play some trend or fad?
Sure, let's do it.
All right. Let's see what I've come up with here. Crypto gaming, trend or fad?
Trend. I think it's an interesting trend because, there's a couple of billion gamers in the world that spend an aggregate amount of $160 billion a year buying in-game assets and in-game stuff, and that's purely a consumption today, right? Like, it's most games are good games, like a Fortnite or whatever, is free to play, but then in order to advance in the game or have a better experience in the game, you have to spend within the game, and that's kind of like a bulk of that $160 billion of annual spend. That's what gamers do. Now, imagine if you were to say to them, there's potentially an ROI on that spend. That 160 billion has a lot more to go. It could be a much bigger number if the gamer was like, oh, this is not just money I spend and it goes away once I consume it. I can actually eventually sell it, get a return on it. That you expand the TAM pretty aggressively. So definitely a trend.
Reddit like non-NFTs, NFTs.
I would say the answer is in between. It's not a trend or a fad. So what I think is a fad in that context is platforms selling profile pictures to people for some amount of money. Like, that made a lot of natural sense to Reddit, right? But if all of a sudden, let's just say, YouTube said, "Hey, I'm going to sell you these profile picture avatars that you can purchase." I'm a YouTube user. I have no utility from having that profile picture avatar. In Reddit's case, the users are there. It's a very small demographic of users, or they have this sort of characteristic as the user base. So that idea of selling profile pictures to your customer base is maybe a little bit of a fad. But one of the things Reddit did that was interesting was they did not call it an NFT. They called it, I think, a digital collectible or something like that. And they made the entire onboarding experience not feel like a crypto onboarding experience. It felt, the user is able to use their credit card to make the payment. It felt like a very natural sort of traditional Web 2 experience, but it was all happening on a blockchain ultimately. I think that's a trend. Like, the user does not want to be bogged down with all these clunky things of using a blockchain. That needs to be abstracted away from the user.
Art investing, trend or fad?
I would say it's a trend. I mean, I don't collect art, but I understand why people do. Been around for decades or ages, art collections. So I guess it's a trend.
Lab-grown meat, trend or fad?
Trend. I'm a big consumer of impossible foods.
And lastly, Twitter, trend or fad?
Oh, trend, especially because I've been, especially in the world of crypto, a lot of the breaking news happens on Twitter. It's not through traditional news news outlets. So I believe in the trend.
Cool. Well, this was awesome. Pranav, thank you very much for joining us on on this episode.
Yeah, thank you for having me.
And what's the best way for people to find you, follow you, read what you write?
I'm on Twitter at PKAN90 at PKAN90. You just follow me there, and I'm not that active, but I do post some stuff. And if I publish something on Medium, you'll see it on there as well.
Fantastic. Thank you for tuning in to another episode of Trends with Benefits.